Len, why are you here? Okay, someone else too. Okay, any other person, your name and your company and what you want to learn from this class, really. Why are you here?
Yeah, good afternoon, everyone. My name is Muideen Adekunle from BO Insurance Brokers Limited. As a finance person, I just want to learn the flow of the posting of this insurance contract in our books. Thank you.
Okay, thank you very much. So I think I will just go straight to the class and we can just learn. So IFRS 17 has been around for a while now, so I can't say it's so new because this 2025, and the assumption is that we have known it since 2023. So to an extent, we have known it for a while. So I want to believe that the knowledge is not as new. Yeah, it's been around for a while. So yeah, this 2023. So even if it's just about 1 year plus or 2 years, it's still been around. So who is it applicable for? Is it applicable for those entities that actually issue insurance contracts? Mark the word, they issue insurance contracts. And whenever you're talking about an insurance contract, is where the insurer is actually accepting a significant insurance risk from the insured. Yeah. So that whenever a loss event occurs, the insurer would have to compensate the policy holder or the insured. So effectively, it is for such contracts or such companies that actually issue insurance contracts. Or if you actually do reinsurance, so reinsurance basically is insuring an insurance company. So basically, if you are also into reinsurance, you are also within the scope and you would apply IFRS 17. In addition, in a situation where you have investment contract with discretionary participation feature, what does that mean? It means that beyond the investment terms, you also have rights to the returns on the pool. So, for example, I invest money, I invest 20,000, and they say, oh, my investment rate is 10%. I'll be getting access to that 10% interest rate. But in a situation where I actually have also returns coming from the pool of all the people that have invested, not my specific contract, from the unrealized investment returns that is remaining, like the profits of the company. If you have such an investment contract that gives you access to the normal financial interest rate plus discretionary returns from that fund, that you might actually need to consider understanding from IFRS 17. So those are the three that will actually require application of IFRS 17. Very simple. So if you look at many of these kind of instruments, they are actually issued by concepts. They are issued by insurance companies. Many of these that we have spoken about, whether it's direct insurance or reinsurance or discretionary investment with discretionary participation feature. So all of these are in most cases issued by insurance companies. Like I said before, for you to have an insurance contract, there must be a significant insurance risk, and the timing of those loss events must be uncertain. And that is when you begin to consider IFRS 17. Now, there are some things that really does not apply, i.e. IFRS 17 does not apply to. For example, when you have warranties provided by a manufacturer or a dealer or a retailer in connection with the sales or services to a customer. For example, you came to buy something from our company and I gave you a warranty that this fan, this ACO, for the next 1 year, it will continue to work. Such is not an insurance contract because that warranty has no significant insurance risk. A significant insurance risk would actually require that there will be an insured event where if such should happen, the insurer or the insurance company would have to pay an amount to compensate the party. But that is not what happens in a warranty. A warranty will be that, if this fan breaks down, you have a warranty for 1 year. So it is not like an insurance contract where there's a significant insurance event, an event that must occur that you would have to pay back. In many of the warranties, what you would have to do is to either repair the asset or replace the asset. So such is not within the scope of IFRS 17 because there's no outlay that you would have to pay as a result of that event or compensation that you would have to pay as a result of an insurance risk that is within. So if there's no significant insurance risk, you are not within the scope of IFRS 17. Or things like employer's asset and liability from employee benefit plan. For example, employee benefit plan is under the scope of IAS 19, and it is like those gratuity. So gratuity, what you are saying is that, when you are leaving the company in 20 years, I will pay you this amount of money, which in most cases will be a function of what you are earning or what you will be earning in that 20 years time, multiplied by probably the number of years you have worked. In such a case, is a liability, but it is not within the scope of IFRS 17. So if you have any questions, please, you can just use the the notification so that basically you can ask your question anytime. So other things that are not within the scope are things like contingent consideration. Already, remember, contingent consideration is already within IAS 37 provisions. And contingent considerations are those that, though you actually have a probable risk, you have a present obligation as a result of a particular thing that you have done. You have but in a situation where it is not probable, but it is possible, meaning that there's less than 50% probability of that particular amount being paid or that particular expense, the liability being crystallizing, then you have a contingent liability. Contingent liabilities are not within this too. So in a situation where you have a contingent consideration payable in a business combination, it is outside the scope. So all this are outside the scope of IFRS 17. I'm going to be asking a question as to what is within the scope in a couple of minutes. But let's look a little bit more, probably more into details. The sincere truth is that the moment you have an insurance contract, there's every probability that as you have an insurance contract, it is within a combo, meaning you have a composite contract where you have both insurance contracts and you also have where you have an insurance contract and you also have an investment contract or any other kind of contract. In a situation where you have that, the standard will require that you actually break them. But you only need to break them if some particular things subsist. So let us look at a couple. So you can actually have a contract where you have both investment contract and insurance contract together. You can have such where you actually have embedded derivative with an insurance contract. You can even have where you have a service contract with an insurance contract. So you can actually have composite contracts, but the standard will require that you break them apart when some things actually subsist. So let us look at some of those. Let us look at where we would have to actually break them apart. Let's assume that we have an insurance contract and an investment contract. Two major things you need to consider. One, are they highly interrelated? When I'm talking about highly interrelated, can you get benefits from one without the other? If you cannot get benefit from one without the other, that means that they are highly related or interrelated. Or you cannot measure one without the other. For example, you have a contract, let's say a life contract, and beyond that life contract, there will still be additional amount that will be paid apart from the percentage that is supposed to be paid to you. However, you can only get that only whenever the insured passes on. So if you look at that, it means that the benefit of both the investment component and the insurance component can only be gotten when the loss event occurs. That means that the two of them are what? Highly related, because the benefits can only be gotten at the same time. Or in a situation where you cannot measure one without the other, we say that they are highly related. The second one you would have to consider, or second thing you have to consider when you are determining whether you should break the insurance contract from the investment contract, is whether there's a particular kind of contract that is sold separately in the market without the investment component or the insurance, when they are not together. Whether, for example, if it's an investment, is such an investment contract sold without insurance component. If that is the case, that you actually have such sold in the market without the insurance component, if these two things are there, one, they are highly related. If they are highly related and there's no kind of contract that is sold separately like that, i.e. the investment contract is not sold separately without the insurance contract, then you will be looking at treating them together as one particular contract. But in a situation where they are not highly related, meaning that they are not highly interrelated, you can get benefit from the investment component even before the loss event occurs. At that point in time, we are saying they are not highly related. And you can even buy an investment component that is like that without the insurance component. When those are like that, you will separate them, because you are saying they are not related, highly interrelated, and at the same time, you can even buy an investment component without the insurance component. If such is the case, then you will separate the insurance contract from the investment contract. You will treat the investment contract using IFRS 9, and you will treat the insurance contract using IFRS 17. Any questions as I go on? As I take this simple example, any questions as I go on? I just want to confirm if I am communicating or everybody's gone. So let me just take it a step. Please, if you can hear me and I am communicating, you can just give me a thumbs up so that I can know that I am not alone. Is anybody there with me?
Great. Yes, we are here.
Okay. I just wanted to confirm. Okay, let's take this question together. Okay, so let's just take this example. ABC Insurance issues a life insurance contract and receives a premium of 1,000 when the contract is issued, the collected premium effectively. Okay. The account balance is increased annually by voluntary amounts paid by the policy holder. So that means the policy holder is paying a voluntary amount every year. Increased or decreased by the amount calculated using returns from specified assets, and decreased by fees charged by the entity, meaning that there is increase on interest and they also charge fees. The contract promises to pay a death benefit of 5,000 plus the amount of the account balance if the insured person dies during the coverage period. The account balance, if they will collect the account balance if the contract is cancelled. ABC has a claim processing department to process the claims received and an asset management department to manage investment. An investment product that has an equivalent terms to the account investment, to the investment account feature, but without the insurance coverage, is sold by another financial institution. Please, do we need to separate this particular instrument, or we are supposed to account for it as one? What do you think? What do you think? Do we need to separate it, or we need to account for it as one, based on the criteria that we just looked at? Anybody, please, you can help us. Hello? Anybody wants to help me? Anybody wants to help me with that? Please, can you see my screen? Anybody wants to help me with this? I just explained the two things that you actually take it through. Number one, the test of highly interrelated, where the component is highly interrelated, and the test of whether such instrument is sold that does not have the insurance component, so that is sold separately as an investment component. Please, you can unmute to answer, please. Should I separate it, or should I account for it as one instrument?
Hello, good afternoon. My name is Maiwa. I think in this scenario, we separate it based on the criteria you listed before. One of the criteria being if the investments coming in. Yeah, since that they have an investment asset management department to manage the investments. Based off that, I think the contract should be separated.
Okay, thank you very much. Any other person wants to help us? I just want a different opinion so that we can go ahead, please. Okay, any other person wants to help us? Any other opinion? I think there should be a second opinion.
Hi, good afternoon.
Good afternoon.
Sorry, not on now. Please, can you just share the diagram again? Just
Okay.
first slide.
Okay, so I'm on the first slide now.
Okay.
Wow.
Okay, I think the contract should be recognized differently because you can ascertain the amount for the different contracts. I mean, they are distinct. You're able to calculate what one component or the other is. So I would say it should be accounted for differently.
Okay, thank you very much. So let's just take it together too. So let's take the first component. The first component is the fact that are they highly interrelated? That's the first question. Are they highly interrelated? And I explained that for it to be highly interrelated, two major things are there. Is either that the benefits, you can't get the benefit of one without the other. And if you look at this, the benefit, the significant benefit of these contracts, you actually get it only when if the person dies during the insurance period. Remember that for you to say it is highly interrelated, that means that the benefits are related, you will get them at almost the same time, or you cannot measure one without the other. So if I look at the first parameter, that first parameter that we add here, we cannot get the benefits of that thing I just showed you. You can't get it separately. You can't say, oh, I want to pick up the account balance. I want to actually take the increase or reduction on the returns. I want to collect it. No, you can't, based on what I just showed you. So you can't go ahead and say, oh, I want to take the returns separately. You can't. Until the person actually dies. So if that is the case, that means that the first one means that they are highly related or highly interrelated. If they are highly interrelated, it's tending towards treat as one contract. The second one is that if there's an investment contract that is sold separately that has some feature like that without the insurance company, yes, there's actually an investment component that is actually sold. However, because it has failed the first one, which is that it is highly interrelated, then we will treat it as one contract. So in this particular case, we will treat it as one contract because it has failed the second one. The two, which is that it must not be highly interrelated and there must be contract that is an investment contract without the insurance component sold. The two of them must apply for you to separate it. So we will treat it as one contract rather than breaking it. In this particular example. Okay, this is that taking, can I take it one step further? Because of the time. So if it is to be an insurance contract with embedded derivatives, then we'll be looking at three parameters or three criteria that looks more like the first one that we just looked at too. However, rather than saying it is highly interrelated, we say the economic characteristic and risk of the embedded derivative are not closely related, which is the same thing as saying they are not highly related. So basically, the economic characteristics of the embedded derivatives and that insurance contract, are they closely related? That's the first thing you need to check. If they are closely related, then you will be looking at it as one contract. Now I'm talking about insurance contract and embedded derivatives that is inside the same thing. Now, another thing you need to look at is just the same way we saw in that same place. Is there a separate instrument with the same terms as the embedded derivative, which would meet the definition of a derivative? Meaning that beyond that particular insurance, is there an instrument there that will meet the definition of a derivative? Like someone explained a derivative to me once. He says, if you see a cat that is barking, you see an instrument that is a cat that is now barking like a dog, that is an embedded derivative. Meaning it's not behaving based on its characteristics. So for example, a bond is supposed to behave in a particular way, but that bond is now behaving like equity. That has some level of an embedded derivative in there. So if you have a separate instrument with the same terms as that embedded derivative, which will meet the definition of a derivative within that insurance contract, a separate instrument. Now, if the answer to this question is basically a no, meaning that you can't break it apart, there's no other thing like that that you can see in the market, then you might want to treat it as one insurance contract. If not, you will not do that. The last one you need to consider is that that instrument, hope is not measured at fair value through P&L. Remember that a normal derivative is measured at fair value through P&L. So if the derivative is measured at fair value through P&L, in a situation where there's no hedge effectiveness, is measured at fair value through P&L rather than through OCI. Whenever you have hedge effectiveness, you are doing hedge accounting, then you'll be looking at an alternative to actually have the having it through OCI. So if there's no hedge effectiveness on it, you are not doing hedge accounting, then you are saying that, oh, since both the insurance component will have impact in P&L and the embedded derivative is not going through OCI but is going through P&L, there's no need to break it into two different components. You will treat the two components as one contract. If not, you will separate the two contracts. So when it's an embedded derivative, you take it through these three tests. Look at the economic characteristics, whether embedded derivative and insurance contract have almost the same economic characteristics, or can you separate them? Or that hybrid instrument, is it measured at fair value through P&L? If it's measured at fair value through P&L, so also is your normal insurance contract. So why break it? And that is why you might want to treat it as one contract. So basically, that determines whether you want to treat it as one contract or you want to break it into the embedded derivative separated from the insurance contract. So this is what you take it through to be. I have one example that is majorly for separating between an insurance contract and other components. Let me actually just read it out. ABC Insurance issues a stop loss contract to Germain Keke Limited. That's the policy holder. The contract provides health coverage for the policy's holder's employee and has the following features. 1, insurance coverage of 100% for the aggregate claims from the employee exceeding 25 million, meaning that anything that is less than 25 million, ABC Insurance will not pay it. Germain Keke Limited will self-insure claims from employee up to 25 million. It's now anything above 25 million that ABC Insurance will pay for. Number 2, claims processing service for the employees of Germain Keke Limited during the next year, regardless of whether the claims has passed the stop loss threshold of 25 million or not. ABC Insurance is responsible for processing the health insurance claims of all the employees on behalf of Germain Keke, even if they are not the ones that will pay it. The question is, in this place, should we account for it as one insurance contract, or we need to break, or their components? What do you think? What do you think? Do we account for it as one single contract, or we need to break them apart? Hello, what do we think? Should we break them apart? Okay, yeah, Ayodeji, you can go ahead, please. You can go ahead.
Thank you very much, sir. I just want to try. Number one, I think this is 2 questions for the case study 2. The first one stated that if the insurance coverage of 100% for aggregate claim from the employee exceeding 25 million, the top loss threshold, the Germain Keke Limited with self-insure claim from the employee up to 25 million. It means that before this thing can be aggregated, that is, without separating it. Now, if you want to separate this, if you assume that we have the first one, the second one can be separated, because in respect of what happened, the Germain Keke must pay them. And this can be treated through the OCI in the financial statement. Why the one that is, if it is not up to 25 million, should be treated in component parts, because if it is lower than 25 million, the Jamaica Keke Limited will not pay. So this will be as an expenses, and it should be treated as profit or loss in the financial statement. Thank you, sir.
Thank you very much. Okay, any other person wants to just give it a try? Just remember, it's all one contract. It's all one contract. The question now is that should we break the contract into two, or we should treat it as one? Yeah. Any other person? Thank you very much, sir. Any other person wants to give it a try? What should we do to this contract? Hello? Any other person wants to help us? Okay, so let's look at it together. So what they explained to us here is that it's just one contract that this Jermaine Keke issued. One kind of contract. However, there's a stop loss inside it. There's a stop loss threshold, which says that Jermaine Keke will, if there's a claim from his staff up to 25 million, they will pay. However, even if there's a claim, all claims are registered by ABC Insurance, whether they are 1 naira, 2 naira, or 10 naira. It is still ABC Insurance that will register it. So if you look at it, there are majorly two contracts there. If ABC Insurance is registering 1 naira insurance claim, they will not pay it. But they will be requesting from Jermaine Keke that they are doing a service for them. For example, they are doing claims administration for them. So if you look at it, claims administration, if, for example, throughout the year they do claims administration, but there was no claims that is higher than 25 million, they will still get paid. And in the example that we looked at here, you will discover that ABC is responsible for processing the health insurance claims. And if you look at it very well, they could also be doing that service for any other person apart from apart from Jermaine Keke. So the first thing is that is the claims administration and the insurance claims of anything above 25 million, are they highly interrelated? The sincere truth is that they are not highly interrelated. They are not highly interrelated. Why? Because the benefit from one has no relationship with the other. I.e., they are doing the service of claims administration, writing the name of all the people that are supposed to collect claim, whether they will pay it or not. And when they are done, at the end of the year, they will get paid for doing that. So if you look at it, they are not highly interrelated. And number two, in this particular place, could they have a contract that is sold in such a way that if they do claims administration alone, would they be paid for that one, even if they are not doing insurance for them? Yes. And because of this particular contract needs to be separated, because they are not highly interrelated, and they are also, you can do the service of claims administration without doing insurance. Any questions? So this one needs to be separated. Any questions on my thoughts? Any questions? Any observation? Can I go on? I need to know that we are listening so that I can go on. Really, I want to be sure that I'm not there talking to myself. So
yes, you can.
Okay, so let's take it a step further. So how do we now aggregate? Now we understand the fact that we are supposed to separate between an insurance contract and other components, whether those components are investment components, embedded derivatives, or other. So in the example that I just printed here now, if I may ask, how will if I separate it, what are the two components? One, there is insurance contract. The second component is a service agreement. And that service agreement is within the scope of IFRS 15, meaning is revenue. It's as if we are doing normal service and we will account for it using IFRS 15. So within this contract I just explained to you, there's IFRS 17 and there's IFRS 15. So basically that is other. So within an insurance contract, you could have investment contracts, embedded derivatives, or other contracts that might, for example, be within the scope of standards like IFRS 15. So aggregation level. Aggregation level basically is looking at how do we aggregate. Whenever you're accounting for insurance contracts, say for example, as an insurance company, are you going to account for them one by one? No. This particular guideline requires that you aggregate, meaning that you need to bring them all together. And whenever you're aggregating, the first level you need to consider is the portfolio level. All of the vehicle insurance that have the same portfolio, the same characteristic, the same feature, you can bring them together. And you can just bring them within a portfolio. And the second level is now within that, you need to group them into sub-classifications. The ones that are onerous at initial recognition. Onerous means that from initial recognition, you have been spending money on that insurance more than the revenue you will get. So for example, you have paid more acquisition costs from the beginning than the premium you will collect. That is an onerous at initial recognition contract. So all of those ones that are like that, you put them in a bucket. So that means that you would have the portfolio. Under the portfolio, you now have the ones that are onerous at initial recognition and the ones that will not have no significant possibility of being onerous, meaning that you are normally supposed to be profitable, the normal ones. You will have them in another bucket, then you now have others in another bucket. So that means that effectively it will look like this: a portfolio, motor insurance, for example, the ones that will be onerous at initial recognition, not onerous or will not be onerous, and others. Now, the standard also says whenever you are grouping them together in your groupings, ensure that there must not be any contract that is more than 1 year apart. Meaning, for example, the ones that you issue for 5-year contracts, you should not put them together with the ones that are 1 year, 1 year contracts. Because contracts that are, they cannot be more than 1 year apart within the same classification. So when, please, do you have a question? Does anybody have a question? Okay, so let me take it a step further. So within that particular motor insurance, onerous at initial recognition, then you now begin to group them into the ones that are within the same period. So for example, all the insurance contract for this particular year. Then if you now have insurance contracts that are like 10 years insurance contract, in most cases you might not have that in only if it's a life insurance, like a 10 years insurance contract, then you want to group them separately. Yeah, so that is the way you group an insurance contract. Remember, I said portfolio level, then after portfolio level, you group them, that portfolio, into 3 major levels: the ones that are onerous at initial recognition, the ones that are subsequently never supposed to be onerous, meaning that they are the normal ones, then you now have others that you now put them there. Others are the ones that have other characteristics. So you have the ones that are onerous, the ones that are less profitable from the beginning, and you have the ones that normally they are supposed to be profitable. You put them into the second classification. So that is the classification or the aggregation level that we are supposed to use. Please, if you have any questions, let us know even as we go on. So let's go to initial recognition with IFRS 17. How do we recognize at the very beginning? So the first question we need to ask ourselves is, when is initial recognition? Initial recognition is the beginning of the coverage period of any of the contracts within that particular classification. Remember, we have grouped them into this aggregation level. So within that aggregation level, the beginning of the coverage period of any of the components within that coverage, within that group, is the beginning of the initial recognition period. And that is when you will recognize. Or the date when the first payment, meaning that, for example, they started paying even before the insurance period started. That will be your initial recognition. If they are paid before that particular contract date starts, that date when they pay will be the initial recognition. Or in a situation where the contract is onerous, meaning that you are spending more than the amount that you can ever make from it. The day it becomes onerous, the day you actually spend more than the amount that you can ever get, that is when you will recognize it. So any of this, the earliest of any one of them is the initial recognition date. Any questions? If no questions, I assume we can hear me. So I take it a step further. So if that is the beginning period, then how do we account for insurance contracts? There are typically three methods: the general method or the core requirement, as it is called; premium and allocation method, which is optional, which is the simplified measurement for majorly short-term contracts; and the variable fee approach, which will actually work more for contracts that have direct participatory features. So these are the major things we are supposed to do. What is the major different thing with IFRS 17 is the core requirement or the general model, which is supposed to be what we should use. So let's go to, remember, I have explained just now that at initial recognition, in a situation where that particular contract has direct participatory features, then you will be using the variable fee approach. If not, you are supposed to use the general model or the core requirement or / premium allocation model. The premium allocation model is the simplified one, which you are supposed to use only for those contracts that are within or short term as they may be. So let's go to, remember, the major one that is required is using the general model or the core requirement. However, in a situation where there are contracts that are short term, then you can go for the premium allocation approach. So let's start with the general model. The general model is the major difference between IFRS 4 and IFRS 17. So let's go in. So at the beginning, initial recognition, and from here, I might not be doing too much talk, I'll be doing more calculation. So at initial recognition, your IFRS 17 insurance liability or assets is the component of fulfillment cash flow plus the contractual service margin. Fulfillment cash flow plus contractual service margin. What is fulfillment cash flow? Fulfillment cash flow is the PV, probability weighted PV of cash flows that you have factored in time value of money for and risk adjustment. Fulfillment cash flow is the PV or probability weighted PV that you have factored in time value of money for and risk adjustment. Now, in this class, as much as I can take, I'm going to teach you how to calculate many of the things I'm talking about. So I'm not going to be talking English. I will be talking English and mathematics. When we are looking at the fulfillment cash flow, like I said, you will factor in 1, probability; 2, PV of the cash flows; 3, risk adjustments. All these brought together will give you what they call fulfillment cash flow. That plus the contractual service margin is what you call insurance liability or insurance asset at the very beginning. When we are looking at the fulfillment cash flow, remember that those cash flow must actually be directly related to the fulfillment of the contracts. Remember that the way to do this under IFRS 17 is to aggregate. So you are aggregating together, say for example, based on portfolio. Then under portfolio, you are breaking them down into contracts that are onerous at initial recognition, contracts that have the probability of being onerous, and others. Now, each of these grouping is now what you are bringing together to now calculate those insurance liability or asset for. And to calculate that, remember, it is the component of fulfillment cash flow plus the contractual service margin. And within fulfillment cash flow, like I told you, PV of the cash flows, and you need to factor in time value of money, probability weights, and factor in risk adjustment. When you are looking at those fulfillment cash flow, they must be cash flows that are directly related to the fulfillment of that contract. Meaning things like payroll will not be there. Things like staff costs will not be there because they are not cash flows that are directly related to the fulfillment of the contract. But things that are like acquisition costs that are directly attributable to that contract, you will need to factor them into the cash flows. When you are looking at these cash flows too, they must be probability weighted, because some of them you are actually looking at the probability of you paying claims in the future, the probability of your premium coming in the future. So when you are looking at it, you are looking at probabilities, because you are not sure whether they will pay next month, or you would have to actually do claims of 50 million next month, or next 2 months, or next 3 months. That is why you factor in probabilities into them. Now, those are the major things we need to factor. And I want to ask a question. Tell me the one, please. I don't know whether you can hear me, but I want you to tell me which one is in or which one is out. Premiums. When I'm doing fulfillment cash flow, should I be factoring in premiums? Yes or no? I just need one person to just communicate with me so that I will know whether I'm really talking to myself. Just tell me it should be in or out. Fulfill premium in or out?
In.
Yes. Claim payments in or out?
In.
Claims reported but not yet paid in or out?
In.
Payments incurred on claims for events that have occurred but claims have not yet been reported in or out?
In.
Allocation of insurance acquisition cash flows in or out?
In.
Claims handling cost in or out?
In. I'm not sure.
Okay, okay. So because it is, he said
Handling
claims
cost
handling
out.
cost. He said claims
Out.
handling costs. Okay, you are saying out. Why? Remember, I told you from here, I said there must be cash flow that relates directly to the fulfillment of the contract. What about if that particular claims is directly attributable to that contract? Please, did you get me? You
Okay,
said
so
out.
in.
No, yes, I'm also talking to the person that said out. Remember,
Okay.
there must be cash flows that are directly attributable. So in a situation where you have like general handling costs, out. Okay. Costs the entity will incur in providing contractual benefits paid in kind, in or out?
Out.
What about if that particular contract is basically for that? Remember, the most important thing is the cost directly attributable to that contract. That's the most important thing in this. If it is directly attributable to it, it will be in. Cost of premium billing. If you can allocate the cost of your premium billing for motor insurance separately, and then it will be. If you cannot, then it will not be in. Premium tax, in or out?
It should be in.
Let me show you something now so that I can actually help. So what should be in and what should be out? Let me just run through a couple of them. Let me just talk about what should be out majorly first. Investment returns is out because basically they are returns, yeah, in your investment. So basically they are not directly attributable to those contracts. It's what you have used the money to do. So if you use it to do something that makes sense, you will have more returns. If not, so it has no relationship with that particular claims or that particular contract when you are now using the assets. Or payment to and from reinsurer. Because remember, the contract we are talking about now, say for example, is on the insurance contract. So if you are paying your reinsurance, even for that particular thing, it will be out. Cash flow that may arise from future contracts, meaning cash flow that you say, as a result of doing this insurance contract with Mr. A, he will give me Mr. B, C, D, and E. Those particular cash flows are out. Acquisition costs not directly related to obtaining the portfolio of contract, meaning that you are saying you are doing money adverts, and you have the opinion that adverts, it will give me many customers. Yeah, you might be correct indirectly to say it looks like an acquisition cost, but it is not directly attributable or directly related to obtaining that portfolio, so it's out. Cash flow arising from abnormal amount of wasted labor, out. General overhead, out. All of those general things, out. Income tax, out. So his income tax is out because income tax is for the company. Cash flow from unbundled component out. So the ones that are in are transaction-based taxes and levies. So you are correct when you said premium taxes. That was why I did not fight it really. Because basically, if it is transaction-based, meaning on that particular transaction, yes, we are together. Yeah? So any questions? Can I take it a step further? Okay, I cannot hear
Sorry,
anybody.
please.
Yes,
Just
ma'am.
one question. Can you give example of a premium tax?
If you have such, yeah. If you don't have such, you don't have such. If for example, there's a tax on the premiums. He said?
Some clients, they charge VAT on premium.
Yes. So if you actually have a VAT on it, any tax that is going to tax people on a premium, they are all part within that place. Remember that when I say income tax, it is not VAT, it's not PAYE. Income tax is only chargeable to a company. You know, company income tax, that's an income tax because it is chargeable on an income. So all of those VAT, we told him they are transaction based. So I said transaction-based taxes and levies is part of the cash flow. Please, have I spoken? Madam, have I answered your question?
Yes, sir. Thank you.
Okay. So now that we have spoken about, at the very minimum, what should be in the fulfillment cash flow, I want to take it a step further. So let's use an example in this our case. ABC Insurance issued 100 insurance contracts within a coverage period of 5 years. I know many of your insurance contracts are 1 year, but I just want to be able to, I don't want to do 12 months. That's why I'm using just like 5 periods so that it's not long. It is assumed for simplicity that no contract will last before the end of the period. The entity expects to receive premium as stated in the table below. ABC estimates the annual cash flows at the end of the period as this. So meaning that the premiums he expects to get is what I put there. Claims that he expects to pay is what I put there. Acquisition cost is what I put there. Renewal commission, maintenance expense is what I put there. The company pays an income tax of 30%, while the general overhead cost is estimated to be 10% of the premium income tax. Assuming a discounting factor of 10%, what is the fulfillment cash flow? So I want to calculate what the fulfillment cash flow on this particular thing is. I think I have this on Excel somewhere. So I want to go and copy it out. Then I will use it. I think so. Let's go and use another Excel sheet so that all my examples will not, I'll not be showing you the answer before the question. Okay. So I think this should be the same thing I have in there. So I think this should be the same thing I have on this slide. 900, 850, 850, 850. Minus, so this is the same thing I have here. So how do we calculate the fulfillment cash flow? Is the PV of all cash inflow, cash outflow. So these are all the inflows. These are all the outflows for the period estimated. So I can now have net cash outflow or inflow, net cash inflow, which will be the summation of all of these things.
Question.
You have a question?
Okay, are you assuming that all of them are admissible in calculating the fulfillment cash flow?
Yes,
so
sir.
We don't have to whether.
Yes, sir. Remember I said we are going to use probability weighted cash flow. So I've not even factored in probability here. I'm assuming that we say that we are going to pay 80,000 next year and it is going to be like that, meaning that you know the future by certainty. Please, do you understand me, sir?
Yes.
Hello? Yeah, so we are going to take it step by step so that I don't bring in probabilities yet. Yeah, so I'm assuming that for this 5-year contract, this is what we think we will get, and this is what we think we will spend from today. So it is in period 0 or year 0 now that we are making this estimation. Okay, so next thing will now be how do we discount it? So let me ask you a question. What do you think I should use to discount it? Now, what I will use, I've said here that assuming a discounting factor of 10%, I will still teach you how to calculate the rates. I will try as much as I can to actually do as much as I can. So let's assume 10% discounting factor. In this case, I will try to teach you how to use bottom up and tops down to calculate interest rate, really. So before I go, I think I should be able to do that. So let's assume a discounting factor of 10% in this simple case. That means that the fulfillment cash flow will be equals to NPV of the rate, which is the discounting factor of all the money that will come in from period 1 till the end. That means that effectively the fulfillment cash flow in this case is 2,922,174.59. Any questions? I just needed to make it simple first as we go on. Any questions on how we calculated the fulfillment cash flow? Remember, I've not factored in risk adjustment. I've not factored in probabilities and stochastic, so I'm taking it step by step. Any questions with this? Hello, online training, is one talking to oneself by faith, talking to more people. And okay. Is you need to have faith to do online training. So now we have taken this. Let's take a second case study. Now I brought in probability of payments. I brought it into this one. That the probability of those things being the amount that you will pay. Yeah, I brought it in. So I said ABC Insurance Company issued 100 insurance contracts with a covered period of 5 years. In most cases, one year that many of your insurance contracts are when they are not live. Yeah. So rather than doing this 5 year average, it's 12 months you are supposed to do, for example. Yeah. But I'm just trying to use just 5 periods so that the 12 periods will not be too long. The covered period starts when the insurance contracts are issued. It is assumed for simplicity that no contract will lapse during the period. Yeah. The entity expects to receive 1 million naira at initial recognition, meaning when, as I am accounting for it now, we are collecting 1 million. ABC Insure estimates the annual cash flows at the end of the period to be 800, 850, and on and on. So the question now is, how much is the fulfillment cash flow? What is the fulfillment cash flow? Let me see if I have that same question somewhere. Okay, let me just copy it. Let's change it together. Let's just change it together. So I'm doing the case study 2. Premium in period is 800, 850, 750. Is 800, 850, 750, 850, 850. This 50, 80, 70. 50, 80, 70, 50, 10. Yeah, 85, 65, 55. I'm trying to make it to be exactly 65, 5555, then 1,000. So yeah, it's the same thing now. And they have a probability of making those payments or collecting those payments, 50, 20, 10, 10. So I put 50, 20, I think it's 50, 20, 10, 10. So let me do the same thing. So let me make this thing to be looking like probability. Okay, somebody, are you asking a question? Okay, yeah. You get the slide, but let's do it together. So these are the probabilities in there. Yeah. Okay, so let's now go and calculate our net cash flow and everything by ourselves. So the first thing we need to do is to bring in the probability weighted net cash flow. So here we need to have probability weighted. So let us first bring in the net cash flow. Net cash flow is the summation of all the money that you say are the net cash flow for simplicity. So these are the amounts. Then we now need to bring in the probability weighted cash flows. Probability net cash flows is effectively what I have here times the probability that those payments will be like that. And I drag them down. So these are the probability weighted net cash flows. Then next thing is now for us to calculate So I'm just going to bring in the same discounted cash flow. So 10%. So the fulfillment cash flow is the NPV at that 10% of all the probability weighted cash flows that will come in or go out. So in this case, the fulfillment cash flow is 593,844.81. The essence of the probability is to make it more realistic, to say that normally in month 1, what is the probability of the claims that we always pay? In month 2, what is the probability of the claims that we will pay claims? What percentage are we going to pay? So basically, that is what I've done here, so that in simplicity, or so for clarity, for simplicity's sake, that's why I've used a simple example. So in this case, this is the fulfillment cash flow. Remember that this fulfillment cash flow, I'm not yet done. Remember in the example that they gave us here, they said that the entity expects to receive 1 million premium at initial recognition. That means that I am not yet done. That means that these guys are collecting initial premium collected at year 0. Year 0 means now. That means this, and that is 1, 1, 2, 3, 1, 2, 3. That means this fulfillment cash flow is equals to this NPV plus that fulfillment, this 1 million. You know why? Because I cannot PV what you have collected today. The time value of money of the money in your pocket is that money. Please, do you understand why I am adding it rather than adding it as part of that cash flow? Any questions? Hello? Please, do you understand? Okay,
Yes.
because that's why okay, so that is the fulfillment cash flow
Yes,
in this simple case. Yeah. So if you have any question, please let me just know. You can drop it in the chat. Now, there's a particular thing that I said I need to teach you, because really, to an extent, why did I take 10%? Where did I find it? Now, how do we know the interest rates or the discounting factor? You remember, I've not gone to risk adjustment, but I want to first remember, for us to actually calculate fulfillment cash flow, it is the net present value, risk weighted net present value, and the risk adjustment. But before I go to risk adjustment, let's talk about where did I find this 10%? How do I calculate it in reality? Now, the discount factor that we use must actually show the characteristic of the outflow or the cash flow. They must reflect the time value of money. They must reflect the characteristic of that particular instrument. Yeah? How do we do that in reality? All this one is English. There are two methods we use, which is called bottom up or tops down. I'm going to teach you the two in very simple minutes. I will start with top down. When we are using the top down, where we start from, please, are we together? Because I'm going to be doing some little statistics really. So don't worry. Remember, this is supposed to be a full 2-day class, but I'm going to do as much as I can within this time. If you have any questions, please let me know. Just raise your hand so that I will not be talking to myself. So the first point you start from when you are doing top down to get the discount rate to use is to determine a yield curve that reflects the current market rate of return. Now, what do I mean? You must be using, to an extent, a reference portfolio. What do I mean in simple English? For example, we have motor insurance. The premium we collected, we invested it in XYZ T-bills or bonds. That bonds or that T-bill is what they call a reference portfolio assets, because we are saying the reference for that particular liability that we raised, that we collected premium for, is on that particular asset. The rate of that asset is where we start from, i.e., we get that particular rate. For example, let's assume that we invested the money from that particular premium on bonds, or let's say T-bill, and the T-bill rate that we invested in, I'm looking at the rate now. So I'm doing top down. So the reference rate, I've taught you in reference rate. I say is the rate of the asset that we invested in with the money from that particular group of insurance or group of contracts. Let's say it is average 15%. So this is our top. Then from here, we are now going to factor something in. Please, do you understand how I got this reference? Is not reflector. Reference. Please, do you understand how we got the top that we are now going to take down? Please, do you understand me?
Okay, yes, but you are assuming that there's only one asset class.
I said even with that, you can do an average, a weighted average. Please, do you, like I said, average, yeah. So let's even assume it's one, or you do a weighted average. I'm just assuming, that, so for simplicity, yeah? So you can do a weighted average to get of that particular portfolio, yeah? So let's assume it's 15, meaning that I've done the weighted average and all that, I have 15, so that it's easier when I'm going to do this. So next thing will now be, inside that 15%, remember it's a risk asset. And since it's a risk asset, that means there are some credit, or let's say it's a bond, it's a risk asset. That means that there are some credit risk inside it. So we need to remove the credit risk that is inside it. That is why they call it top down. So it is top, then we remove the credit risk that is not supposed to be there, and we'll now get what we should use. So that credit risk that we are going to remove is what they call credit risk premium. To calculate a credit risk premium, in reality, we use PD multiplied by LGD. Or, sorry, probability of default multiplied by loss given default. Let me try to make it realistic for you. What is probability of default? You know that the most prominent credit risk is what they call risk of default. You know, in a normal credit risk, you have things like risk of default or default risk, and you also have concentration risk. But the most prominent one is the default risk, the risk that they will not pay. Yeah? So we are saying that, that bond, that reference bond that we are using, there's a risk inside it called credit risk, the risk that they will not pay. And to calculate that credit risk, we use PD multiplied by LGD. So we are going to calculate what they call the credit risk premium. And we said credit risk premium in very simple English is PD times LGD. So now I need to teach you how to calculate PD and how to calculate LGD. To calculate PD, or probability of default, we can do simple risk, what they call risk scorecard. So for example, normally, how do you discriminate a risk? So for example, let's say is a bond we are talking about. So let's say within that portfolio of bond, how do we determine that the bond from Nasarawa is better than the bond from Abuja, if it is ever possible, or the bond from Ekiti State? You know, there are some states that don't pay their bond. That don't pay when the money body. Yeah. So how do we discriminate and say one is better than the other? Looking at the credit risk, we factor in attributes that we call credit attributes. So let's use a bond normally. Let's assume that because of the kind of place you play, you say, oh, what would determine the kind of bond is nature of bond. Let's say nature of bond is nature of bond. Let's say nature of bond is looking at, or no, let me say Ijua. Number one, Ijua. Ijua could be national government, international, state, yeah, Abi? International. Now, I want to be, which kind of bond do you think is more credit worthy? National, state, or international? This one we need to do together. Which one is more, if you want to rate them, which one is better? National bond, like FGM bond, state bond, like a national state bond, or international like supranational bond? Which of them is more, national, or Euro bond?
Well, for me, national. Because of country risk for international. Okay,
so let's say, you said national, Abi? Anything you say, I put to. So let's say national will be rank 3. International, if it's 1 to 3. International will be ranked what? 2. It's you that is saying it, though. I'm just typing what you have said. So these are your own risk parameters. So let's say apart from that, you also use let's say you also use the tenor. Tenor be, or let's say we use also the credit rating. Yeah, credit rating. Let's say rating A plus. I'm just going to put something above. So even if it's not, so that it's not too long. Yeah. No, I know. So which one would you prefer? I believe you would prefer just, you understand me, am I right? I don't want to write too many things so that the thing will not. What other thing do you think you would check when, apart from the issuer, to know whether it's credit worthy or not credit worthy? What other thing do you think you check when you are going to invest? Let's also say we check the profitability. Yeah.
Financial
The
strength.
profit. You said?
It's okay. Financial strength. It's okay.
Yeah. Let me use your word, financial strength. So all the bonds you have, you are now going to rate them. So I'm going to assume now that we have rated all the bonds you have that you have been buying all this while. I want to put them here. Let's say this is the purchase date. Now this is hypothetical now. Let's say this is 1/1/2021, and we have issuer, and we have Nigeria 1, 2, 3, and we have amount, and we have the credit attribute. So what I want to put here now is credit attribute 1. So let me even copy them from here. Issuer, credit rating, financial strength. Issuer, credit rating, financial strength. So I'm going to assume some things here. So let me just drag this one down a little. I want to teach you how to calculate the PD now and the LGD. That's what I'm doing now. So let me say few months so that the thing will be long, small. It will look like real life data. Okay, I'm just going to drag this down. You understand what I'm doing? The name of the issuer, Sha. Let me do a random here. Random between 1, 1, 2, 3, 1, 2, 3, and 1, 1, 2, 3, 1, 2, 3, so that I can just get different amounts. Yeah, as if it's real. Yeah, so I'm just trying to make it a little bit realistic. So remember these ones, I ranked them between 1 and 3 for each of them, 3 being the best. So I'm going to hypothetically say this particular bond, for example, is the federal government bond. Credit rating is 3 and everything is okay. However, this second one is a state government bond and it is, please, do you understand what I'm doing? So I'm actually just trying to have different ones. So I'm going to do a random so that I don't need to do it one by one. Yeah, random between 1 and 3. Yeah, so let me also drag this. So I'm just doing this so that I can have, this is as if it's your data that you are doing this thing on, that you are doing a credit risk rating on, is your data. Okay. Now, because these are historic data, you know whether they defaulted in their payment or they did not default. Please, are we together? Because these things are calculatable, so I'm not picking any figure anyway. All these ones are like your data. Please, do you understand what I mean by all these ones are like your data? Somebody needs to answer me. Please, do you understand where I've gotten to? I did, this is like your data that I'm just mining. Okay, so however, default or no default, meaning did they pay when they were supposed to pay? You know that there are some states, they don't pay when they are supposed to pay. Later, they will now pay. Yeah, they have entered default by not paying when they are supposed to pay. So I'm going to say people that defaulted is a 1. People that did not default is a 0. Please, do you understand me? So I say, oh, this first one, no, they didn't default. This second one, they defaulted well. This third one, they didn't default. This fourth one, they defaulted. Now, this thing I'm doing now, I'm just going to copy it across. This default or no default, they are things that has happened already on your data. So it's not as if, it's like we are using your data to calculate what you want to calculate. Because many of those things, it's not as if you are picking anything from anywhere. Your data can give you exactly what you need. So let me say all these ones, they didn't default. They are good people. Yeah? So I have default or no default. So let's calculate this thing together. Now, to calculate PD or probability of default. Probability of default, let me go and put the formula here for you. PD is calculated as exponential of logits, exponential of z over 1 plus exponential of z. And that's exactly what I'm going to do. Don't worry, it's very... Okay, somebody is talking. Okay, not talking yet. Now, this is the way we are going to calculate it. But z, this z is what they call the logistic line. And logistic line is just a logistic regression, which is intercept loss coefficient times variable 1. Variable 1 in this case is score of issuer plus coefficient 2 times variable 2. Variable 2 in this case is credit rating plus coefficient times coefficient 3. Coefficient 3 in this case is actually financial strength. So let's go back to here. So to calculate this, the first thing we need to be looking for is the z. The z is what they call the logit. That z is what they call logit. And I explained to you before that the probability of default or PD is equals to exponential. When you type EXP on Excel, that's exponential. Exponential of logit over 1 plus exponential of logits. I don't know logit yet. So if I drag it down, it's just a straight line. But we are just starting. Now, even while here too, let me also put in another major thing that I need to put in before I now go and calculate logit. So I've not calculated PD yet, so I can't just use 0.5. Now, next thing I need to bring in is log loss. Log loss is the deviation between calculated PD and default or no default. What do I mean by deviation? It means that I want to plot this PD line to take into cognizance relationship between the credit parameters and default or no default that has happened in the past. To do that, I can actually look at the deviation between expected and actual. And when I'm done, I can now take that line and make it to look like each other, i.e., remove the loss or the deviation. I'm going to not talk too much so that I don't confuse it, because this is actually a normal 2-day class for us, and it's a very statistical class. So it's something that we do more like building a castle rather than rush. But I'm going to put the formula there so that you will see. It's very simple. So it is equals to actual default or no default times natural log of... Please, are we following me first? I need to be sure, because I think I need to be sure that I'm not... Are we together? Hello?
Somehow.
Hello? We are together? Okay, I can go on now. It is equals to default or no default times natural log. If you type LN in Excel, it will give you natural log. Natural log of expected PD plus 1 minus actual default times natural log of 1 minus expected. can Google it. That's the way you calculate log loss. And that is the log loss I've calculated on this side. Remember, what I want to calculate is PD. Just watch. Oh. Now, all of these things that I have here, I don't know the coefficient. Remember the formula. The formula is that Z is equals to intercept plus coefficient. I know X1, X2, X3. X1, X2, X3 are all of these parameters here. All these 2, 3 that we put here. But I don't know the coefficients. But Excel can give me the coefficients. So let's go and employ the power of Excel to give us coefficients. So let me copy this one to this side. I want to now calculate here. Let me do transpose. This thing I put here, I want to get the intercept, which I don't know, and the coefficient for issuer, credit rating, and financial strength. Here, let me put average log loss. So to bring in average log loss, I can just do equals to the average of all of the log loss that is here. And I close the brackets. The moment I've done that, this is the average log loss. I don't know these things. I don't know it at all, but I need to calculate it. But before I calculate it, remember this formula I put here, which is the formula for Z. I want to come and put it here. I have put them here, but there's no figure there. So I'm going to say Z is equals to intercept that I don't know yet, plus coefficient of issuer multiplied by the score of issuer on this level, plus score of credit rating times issuer, the coefficient, plus coefficient of financial stability or strength times the score. Now, because all of those ones on column O, they are actually, I want to drag it down. I need to make it absolute so that when I drag it down, it doesn't drag down all of those ones on O. So I'm going to make it absolute. And make the last one also absolute. And I drag this down. So I don't know it yet. It's still giving me a 0. But Excel can help me. Now watch Excel. If I put my cost on average log loss and I go to data, under data, there's something called solver. I click on solver. It will give me this thing. Solver is like an iteration. It's an advanced iteration. So I come and I say, I want you to solve this equation for me. The last equation. Solve this average log loss for me by minimizing it. And when you minimize it, change the variable that is supposed to be inside intercept, issuer, and credit, all of those coefficients. Change them. And when you are doing it, make unconstrained variable non-negative, uncheck, and ensure that it is GRG non-linear because I'm doing a logistic regression. And I'll just click on solve. And the remaining is Excel that did it. You see that it's not me. All those things is not me. So I click on OK. Now watch. The probability of default has been calculated. We did it together. So you can know whether I did anything or not. I didn't do anything. So here, you will discover that when the default is 0, probability of default is less. When the default is 1, probability of default is high. When the default is 0, probability of default is less. When the default is higher, what is it doing? It's looking at the parameters, issuer, credit rating, and financial stability to calculate this PD. So let's assume this is a portfolio. The average of this thing that I've calculated as PD, don't worry, during the full class, you are going to do your own. It will not only be me. This average is what I will be using as the PD that I want to use here. So from here, I can go and bring the PD. And the PD from the example I just did now is average of 0.22. That is the PD. I also need to calculate the LGD. Because of our time, I think I will not calculate LGD because of the time. I can just calculate it for you using the same data. LGD is 1 minus recovery rate. Put in another way, is exposure at default minus PV of recoveries over exposure at default. It's very simple. However, because of our time, let's go on so that I can actually still do a couple of things more. So let me just assume an LGD. Please, do you understand anything I'm saying? Ooh, I think I started talking to myself. Online training, eh? I need to take a pause now. Let me now ask. Am I talking to myself?
Okay.
Not at all. We are more than
Wonderful.
60 here.
No, sir. No, sir. No, sir.
No,
No,
no, I can see 60 people, but that 60 people might. Okay, thank you very much. So let me go on. So to an extent, that is the way I can. So let me just assume an LGD because of our time. So let's say LGD, loss given default, is the loss as a result of the fact that when there's a default, you can't get anything back. That's why they call it loss given as a result of a default. Meaning when a default has occurred, what is the loss that you might get? You know that there are some companies, even when there's a default, you can go and sell their assets. So in that particular one, the LGD will not exactly be 1. When the LGD is exactly 1, that means nothing for you, 0. When the LGD is 0, that means that effectively you can get your money. So let's assume the LGD in this case is 0.1 for sake of simplicity. So using top-down as our approach, top-down will be calculated as reference rate times open bracket 1 minus the credit premium. Remember, credit premium I say is PD times LGD. So that is the credit risk premium in this case. So the top-down rate discounting factor, remember what we are calculating, that we said you can use top-down or bottom-up is the discounting rate or the discounting factor. So using top-down, it is equals to the reference asset rate minus, times 1 minus the credit premium. All of these things, they are on the slides. Don't worry. I'm not actually doing it. I'm doing it so that for my head, but it's all on the slide. This is the example on the slide. So I'm following through. I'm just giving you real life examples. So in this case, this is it, and I press enter. So in this case, the top-down rate that you will use as the discounting factor, rather than using the 10% I used here, is 14.667. Any question? That is the top-down approach. Any question? I want to teach you the bottom-up approach. Any questions? Can I take it a step further before we go to bottom-up approach? Do you understand how to calculate the rates now? Don't worry, you will come for the full class at that point. But this one is only for people that are in insurance company. If you are not insurance company and you don't do this one, you don't need this knowledge. I will tell you that, or you are not a consultant. You don't need this one. Oh. This one is not for exam. This one is for reality. Any questions? Can I take it a step further and go to bottom up? Hello, can I go a step further? Can I go to bottom up?
Yes.
Okay, so let's go to bottom up. With bottom up, where do we start? With bottom up, remember top down, we started from the reference asset rate. With bottom up, we will start from the risk-free rate. So the top down is, you will start from top and you will now remove some things from it. What are we removing from top down? We are removing the credit premium, because inside that particular asset is a credit asset. So we are removing the credit risk premium from it, so that credit risk could have been expunged from it. But when we are doing bottom up, we are starting from the risk-free rates. The risk-free rates. Yeah? So that is your starting point. You are saying, oh, the rate of government securities, the risk-free rates. So let's assume a risk-free rate of 10% of such instrument. For example, T-bills are the ones that have like probably 365, very short term. FGM bonds, I don't know whether you have anyone that's like 1 year. So if you actually use that rate on your normal 1 year instruments, that is what I'm saying. Or your normal 1 year policies, that is what I'm saying. So we have taken the risk-free rate. You know where I pick it from. I just gave you an example. Now we now need to factor what they call illiquidity premium. Illiquidity premium. Why? are we factoring in illiquidity premium? So you know that the kind of instrument that you hold, in most cases, they are instruments that are going to probably be for the whole period, long term. And as a result of the fact that it is long term, those fluctuations in the market, you are not factoring them in. The liquidity component, you have not factored it in. So that is why it's called bottom up. Meaning that that instrument that you are using, they are like government instruments, they will not be sold during the period. The government instrument is for a longer period. Now, you are now going to factor in the fact that there's a premium as a result of the fact that you are not factoring in the fair value of those instruments. We need to factor it on it. That is why it's called bottom up. So we need to bring in that illiquidity premium and add it on this particular thing. The question is, how do we do that? So the same way, when we were doing the other one, we factored it. I taught you how to actually calculate the probability of default. Now, you are going to actually have a band. I'm going to make it as simple as possible. You are going to actually have a band to adjust the probability of liquidation. Now, for example, within your company, how often will somebody say, I'm not doing again? Give me my money back. The probability that they say, I liquidate, the person surrender and say, I not do again. That probability of liquidation or surrendering, you need to band it. I've given an example here that the probability of having, we have like a low band, that, the probability that between 0 and 3, 33.3%, that there will be a, what do you call it, a liquidation. And this is from your historic data. It's looking at the probability that there's a termination, that they cut it off, the probability of stopping it. It is from the history of termination of your contracts. And based on that, we can band them like into band A, band B, or low band, mid band, high band of probabilities of liquidation. So in this case now, and also don't worry, I just want to do as much as I can, but I know that this thing is telling me I only have 22 minutes. This class, like I said, is a full 2-day class and is majorly statistics. So now, rather than doing too much statistics, I'm explaining some of them. Just the same way I jump over LGD, but I would have done it fully in the class. So I'm going to assume, because of, as much as we need to do, a premium, a liquidity premium, to factor in that illiquidity premium of 0.5. But remember, you are supposed to break it into banks or bands and say, based on the history of termination of contracts, which ones get terminated more? And if we take all of them, what is the probabilities of termination? Where does it fall more into? Is it the low band, mid band, or medium band? For you to calculate the probability that, or the liquidity premium, which is what I'm going to use to factor this in. So I've used an example here, just the same way I did here. Remember, I actually calculated the PD for you here. I didn't just take 0.2, but I didn't calculate 0.3. Why? Because the time is flying now. Yeah. So in this case, I'm going to assume a 0.5. So if I'm actually doing a bottom up, what I will just do is the risk premium or the risk-free premium, in this case, is 10%. Illiquidity premium, I am saying assuming a 50%. 50%, meaning 0.5. Then that means the bottom up is equals to risk-free rate times 1 plus the illiquidity premium. And that will give us this particular rate. This thing is not 0 rate. So times 1 plus the 50% that we have here, and that will give us it gives us this particular rate. This 15% is now the bottom up that we'll be using. bottom up is 15%, top down is 14.66. You can use any of the approach. You don't need to do the two and choose one. You can just use any one of them to discount this thing that we discounted. So I just use that as an example to determine for you where you calculate the 10% that is up here. Any question as I take it a little step further? I would have loved to do more. I want to see whether I can do risk adjustment, even if I can do cost of capital or value at risk for risk adjustment. I don't know, the time is flying really, really fast. Yeah, it's really, really flying. Any questions at this point? I don't like to speak too much English, is to speak the calculation. Any questions? Do you understand anything I've done? At the very minimum, I have taught you how to calculate the contract fulfillment cash flow. I've taught you how to get the rates, whether it's bottom up, top down for your fulfillment cash flow. Any questions? I am people are going. Two people have gone. Oh. That means that I've started talking to myself. The moment people leave my class, I know I've started talking to myself. Any questions I need to know before I go to risk adjustments? Okay, even as we are doing this, okay, please, I think some of my colleagues have actually dropped something on this chat group. So we're going to send these slides. There's every probability that some of these things, the time required to do this is actually much. So they dropped a questionnaire there. Please fill it and put your email so that they can actually send the slides to you too. Because I know very well that I only have about 22 minutes. I've done already 1 hour, 38 minutes. And it looks as if we are just starting. That is how IFRS 17 is. So we'll be having a full class very soon. So I will suggest that you actually join the class. Risk adjustment. Please fill the questionnaire so that they can send the slides to you. Risk adjustment. What is risk adjustment for again? Because already, remember I explained to you, I said the fulfillment cash flow is the probability weighted PV of those net cash flows and the risk adjustment. What is risk adjustment? Risk adjustment basically is to factor in the non-financial risk. You know, whenever you are doing a fulfillment cash flow, is financial risk. That is why we're actually using a discounting factor. That was why we're using a discounting factor, because we are considering the financial risk. But now we need to factor in the non-financial risk arising from the insurance contract, which includes things like the risk that you might not pay premium. Because we have factored in some probabilities in the other place that you will pay premium in month 1, month 2, month 3. How sure are we that you will not pay? You will pay. Risk adjustment. So risk adjustment is to bring in the non-financial risk, calculate it into the fulfillment cash flow. There are two prominent ways that I want to teach us. We either use the cost of capital approach or we use the value at risk approach. Now, many of us that are in the insurance business, many of us that have been in the insurance business, you know that this already, when you are doing your solvency, the form is on this questionnaire. Please, admin, can you help me send it again? The form is on this charts. This chart, this kindly fill the questionnaire. That is the form. You can just fill it. It's a Google form. It's a Google form. So basically, it's online too. The form is just on this stuff. So you can use cost of capital or you can use value at risk. Cost of capital and value at risk, I know I want to do the calculation, but in all sincerity, let us say that we have a full class, I think, next month or next 2 months. Next month, I think they will send you, you will see it in the survey too. So please, I think, let me shift from there, because if I go into another calculation now, we might be doing another 30 minutes or 1 hour for just cost of capital. So we can use cost of capital or value at risk. And I have calculation for them. I prepared calculation for them, really. And I don't want to bore you too much with too much of my calculation so that you will not run away. So, however, I have also calculated examples here for whether you are doing cost of capital approach or you are doing value at risk approach. Yeah. So you can use any of the two approach and you will be able to calculate your risk adjustment. But for this class, let me just say that when you have calculated the risk adjustments, that is when you can now put it as part of your fulfillment cash flow. Now, because at the minimum, I want us to actually be able to, at the minimum, be done with initial recognition. Yeah? Remember, I explained before, in the full class, I'm going to teach you how to calculate risk adjustment. Please, let's put that down, that in the full class, I will teach you. It's on the slide here, but because of the time. Remember, I explained that at initial recognition, your asset or liability is fulfillment cash flow, which is the probability weighted PV of the net cash flows, and the risk adjustment that we just spoke about, and contractual service margin. Remember, we said that before. So how much will it be at initial recognition? How do you calculate contractual service margin? Let me go straight to real life. Let me use an example, even as I try to, I'm not going to take too much of your time. Contractual service margin basically is that amount, yeah, that represents the unearned profit that the entity will recognize as it provides the insurance contract. Let's put it in a more realistic way. Yeah? Let's use an example. Let's assume that we're using this example that we are doing on Excel. No, we have calculated one, and we said fulfillment cash flow is 1.5. Yeah? Let's also assume that the risk adjustment is, say, for example, 50,000. Yeah? Risk adjustment is 50, or let me use the first one here. Let me use the first one here. It's the same thing, however. Let's say risk adjustment is 50,000. So how do we calculate contractual service margin, CSM? Contractual service margin is equals to the fulfillment cash flow, which is a net cash inflow here, minus the contractual service margin. That is the CSM. So the CSM at initial recognition is the amount that equates the fulfillment cash flow, so that there's no gain, there's no loss. So the CSM at initial recognition is the amount that equates the what? Fulfillment cash flow, so that there's no gain and there's no loss. However, in a situation where it's an onerous contract, when it's an onerous contract, it means that you have already spent more than even the total amount that you collect on that contract. At that point in time, the total amount that you would have brought in as a CSM, you would be expensing it in P&L. It will be expensed straight as a loss in P&L. In that case, you would not have a CSM. Let me try to put it in a simple accounting entry for you. That means that I have fulfillment cash flow, I have risk adjustment, and I have CSM. So that means debit, credit. Fulfillment cash flow is a debit because it's a receivable. Risk adjustment is reducing it, and CSM as at that date will be this amount. This is the initial recognition at the very beginning. But in a situation where you now have an onerous contract, let's use this example for example. Let's consider a group of insurance contracts that has a risk adjustment of 750. PV of the future cash flow, net cash flow is 4,250, and the premium that you are collecting today is 9,000. That means the CSM will be equals to the 9,000, which is the premium you are collecting. You are now taking out of it all the net. Remember, I said that thing is net cash, net outflow. Net outflow means that you are not collecting more money in the future again. You're only paying claims. That is why I'm adding them without risk adjustment. So if I add the two together, I'm going to be having a 4,000, which is the fulfillment cash flow. Remember, the fulfillment cash flow takes into cognizance the risk adjustment. So the two of them together, these two of them together, this one is just the PV of net cash flows. The fulfillment cash flow is the sum of these two, which is PV of cash flow and risk adjustment. And that is that's the fulfillment, and that is the same thing as the CSM at initial recognition. But when I consider a group of another contract where risk adjustment is 750, and PV of the future cash flow, net outflow is 4,250, and the premium you are collecting today is 2,000. meaning 2,000 minus 4,250 that you will pay in the future. Then you will remove 750 again. That means you have a loss of 3,000. Because it's already a loss, there's no CSM for such. What you will do is to recognize the loss in P&L immediately. They call such onerous contracts. Onerous contracts. Any questions? Now, to know whether you get it, I'm sorry, I because of the time to know whether you get it, I want you to do for me this very simple one. And somebody will help me to answer it. Consider a group of insurance contract. Risk adjustment is 1,000. PV of future cash flow, net cash flow is 5,250. Premium that you are collecting today is 1,000. How much is the contractual service margin? Please, somebody will help me. How much is the contractual service margin? The form is online here. The form is on this this chart. This chart where you are. The form that you are supposed to fill is on this chart. This chart, you will see a form that has been sent on this same chart. Please, admin, tell them. Okay. Yeah, it's on this same chart, please, so that you can just, okay. So please, anybody wants to help me? What is the CSM of these particular ones? Anybody wants to help me? The first case A, what's the CSM? What's the CSM of case A?
Minus 5,250. Did you hear me?
Me, I can hear you. I'm with you.
Okay, so I said minus 5,250.
But is that you have a CSM of minus 5,250?
Yeah.
Your answer is minus 5,250. Okay, thank you very much. Any other person? Somebody else said 3,250. For which one are you calculating first? The first one is case A. We are still looking at. To leave case B alone. Let's start with case A. Case A. So remember, this thing says is a. So let's do it together. Let's do case A together. Let me go to Excel.
Oh, sorry. It's zero. It's zero. If it is negative, it's zero. There's no CSM.
CSM is zero in this case. So what we have here is because it's an onerous contract. So since it's an onerous contract, you don't have a CSM. CSM is zero. However, the loss you will recognize in P&L is equals to 1,000 minus 5,250 and 1,000. That's 6,250. So what you have is a loss of 5,250 as P&L, a loss. Yeah, so that is what we have. What about case B? Case B, there's a premium of 10,000 and how much will be, do we have a CSM in this case?
Yes, we do.
Okay, that's good then. And the CSM is 10,000 minus 6,250, which is 3,750. Yeah, so, okay, thank you very much. I actually prepared to do more, really. I prepared to give you a lot of more tasks. However, I think I'll be inviting you to the full class that I believe will be in July or August. I believe there should be one in July and August, or August, I'm not sure. But the people sending the survey, they'll be able to actually tell us. Thank you very much. I'm going to stop at this point because I think I've done 1 hour 54 minutes and it's a 2 hours short class. So please, any questions? Have you learned anything? Is it a waste of time? And now I need to hear from you because I won't lie to you. Talking and doing online training is with faith. You do it because you need to have faith that people are listening and you're not alone. So please, what have you learned? I just have about 5-6 minutes to leave this. So what have you learned? What have you learned? Anything? Now I know that I've not
Okay,
taught anything.
for me, I've learned a lot. Yeah, starting from aggregation level. Sorry about the background noise. The initial recognition, having to understand that the initial recognition, I have to pick the earlier of three conditions: the beginning of the coverage, the beginning date of the coverage, the date when the first payment is due, and when the contract becomes onerous. Then also you had mentioned about the measurement model. We have three, and we have one which is majorly, should I say, recognized. Now that's the general model, comparing it with the premium allocation, variable for approach.
Yeah.
Then under the general model, you are taught us how to compute the initial recognition, which has to do with the fulfillment and adding that to the contractual service margin. Then you give us a breakdown of how to compute the fulfillment amount, considering the probability, the risk adjustment, and the present value of cash flow. Then you did amazing calculations on how to get the discounting factor. And what else did I learn? Then, of course, how to arrive at our CSM, knowing that if it is a negative figure, then the CSM is 0, and that amount would have to be recognized in our P&L. And when should I say, the result is positive, of course, we have the CSM. Then every other thing I've learned today.
Thank you very much. That's a wonderful summary. Thank you very much. Okay, thank you very much. Please, you can just fill this. We'd like to have you at our full classes. I think we have some full classes coming up very soon. Thank you very much. I'd like to at least say thank you even as I leave the class. Please fill the survey so that we can get your email to send the emails to the people that they'll send you the slides so that you can actually go through too. Yeah. From GODP, would like to say thank you. Would like to actually be a part of your success in your company. So please, our trainings are very, very value adding and would like you to actually join us. Okay, have fun. Bye-bye and have a lovely, lovely, lovely day.
Bye. Thank you.